What's up guys, Jake here. In today's video, we're going to talk about a unique situation that occurred in the market that is leading to a lucrative opportunity to sell put contracts. And this newsworthy event is the situation involving Archegos Capital Management. This occurred about a month ago and kind of caused this panic in the banking sector. Maybe you heard about it. However, when it occurred, I was looking at the drop in prices of some of these companies and thinking, are these buying opportunities? So this capital management company, Archegos, was heavily leveraged. They were something crazy leveraged, like 6-to-1. They were borrowing billions from certain banks that once they figured out what they were doing, borrowing money to pump up these stocks, they decided to do a margin call, which led to a massive sell-off of certain companies that Archegos was targeting. So the two big American companies is ViacomCBS and Discovery. There's some other Chinese stocks that they were targeting, but I don't really have an interest in them. And this is what a margin call looks like. So this stock in November was at 20 bucks and it shot all the way up to $80. So Discovery Mass Media Company owns TLC, Animal Planet, HDTV, Eurosports, Shark Week, Science Channel. It's a good multimedia company that makes a lot of money selling advertisements. I feel like going into the summer months and especially the holiday months that companies ramping up are spending more on advertising, and Discovery should be doing pretty well this year. Same thing with ViacomCBS. It's a huge multimedia company. They own CBS, BET, Nickelodeon, MTV, Comedy Central. And this stock was at $30 a share and then ran up all the way to 100 over a 4 or 5 month period. This was because of Archegos. What was their master plan when they were pumping it up 4x, 300% in 4 months? I don't know, but this stock, along with Discovery, got crushed real fast. And before buying a stock or buying an option on a stock, I always check the fundamentals, and it's a little bit difficult with these companies because these companies are constantly acquiring other companies to increase the multimedia conglomerate that they're building. So we'll look at Discovery first, and we'll look at their revenue. Yeah, the revenue's increasing. This is something that I like to see. We'll look at their net income, and this is going to be wonky because when they make acquisitions, they're spending money. It shows up as negative. Shares outstanding, once again, it looks weird because they issue new stock when they acquire new subsidiaries, so it looks a little strange. We'll go to price ratios, P to E. They're currently valued at 21, and it's a little high compared to where it's been valued in the past, but once again, I think this company is actually doing pretty well. Price to free cash flow, it's currently at an 11, and it's high for where it's been. In the past, it's been 15, 18, 20. I still think the fundamentals of this company are good, but the stock chart is just incredible to me. So here's the 6-month view for Discovery. Once again, it was down at $19 last October, shot up all the way to 77. The margin call occurred, and Archegos was forced to sell all their stock. What happens then is anybody with a stop loss 10, 20, 30% lower, those automatically trigger in the panic sell. And then the short sellers jump in on the stock because they see blood in the water. So the stock didn't bottom out. It cratered between April 22nd and April 26th. However, when does it finally bottom out? A stock hasn't bottomed out until the short sellers have to close their position. So when you see maybe like 2 consecutive up days in a row, then you know the stock has potentially finally bottomed out. So I didn't want anything to do with this company or this stock when this occurred initially. So the crash finalized, I guess, on 3/26. However, it just kept drifting down as the stock was radioactive. People didn't want to touch it. And by 4/20, April 20th, almost a month later, I think we've reached the bottom where this stock is probably going to start drifting back up as short sellers exit their position. Anybody who was frustrated with how much money they lost in the stock has probably already gone out. So this seems like a buying opportunity now, which is why I'm interested in selling a put contract. Let's look at Viacom real quick and check out their fundamentals. Once again, it looks weird because they're constantly acquiring other companies. So at the end of 2018, Viacom and CBS merged under Viacom, I guess. So that's why all of these metrics look a little weird. Net income, profitable, I guess. Shares outstanding. Once again, this is going to look really weird as they issued stock to acquire CBS. Price ratios, P to E, 10 currently. Not terrible, I guess. Price to free cash flow, and they're sitting at 13, which is lower than where it's been valued in the past. It's been in the 20s consistently over the last 7 or 8 years. And same with Viacom's stock graph. Once again, the stock was as low as $27 last October, shot up to $100. That's almost a 4x increase in 4 months. This was Archegos pumping up the stock. Margin call, everybody panic sold, the short sellers jumped in, stop losses were triggered. It then just kind of drifted down. It looked like the crater finished on 45. However, people kept selling it as they were frustrated with the stock being radioactive. On April 20th, it looked like it had finally bottomed out, and I think it's going to start drifting up again, which is why I want to sell a put contract on Viacom. So these are the two monster put contracts that I've sold in my Schwab account for my brokerage account challenge, and they're Viacom and Discovery. The expiration date is May 21st, so in 28 days. For Viacom, I chose the strike price of $41. The current share price is at $41.71. So I selected the closest strike price below where the share price currently is. Same thing with Discovery, May 21st in 28 days. Strike price is $37.50. The current share price for Discovery is $38.40. So once again, I think I went with the lowest, the next out of the money strike price for a put contract. And the premiums that I was paid was $250 for Viacom, $159 for Discovery. We'll go over the math why this is so good. But first, let's look at the option chain for Discovery, and I want to point out to you IV, implied volatility. If you're a seller of covered calls or seller of cash secured puts, how you know if you're getting a good premium is if the IV is really high. Now, these are some wild stocks when the IV gets this high. Normal, calm, day-to-day, stable, blue chip stocks, the IV is going to be in the 20s, maybe the 30s. If it gets up to 40, it means there's been some volatility recently. Above 40, and basically the stock is just going crazy. So the strike price that I chose of $37.50, the IV is 47.9. And the other thing you might want to reference is Delta. Delta is telling me 41.3%. That's the probability, according to the Black-Scholes formula, of this option expiring in the money, and I'm assigned and I have to buy 100 shares of this stock. The buyers are bidding $1.60 and the sellers are asking $1.75. I put in a limit order and I got assigned at, I guess, $1.60 minus the commission for the Chicago Board of Options Exchange. So the strike price is $37.50 and my break-even price is the strike price minus the premium, $1.59 multiplied by 100. So my break-even is $35.59. As long as Discovery's stock price, well, first of all, if it goes below $37.50 by May 21st, then I'm assigned, I have to buy 100 shares, and I'm okay with that at that price. However, I don't really lose value because I was paid the premium unless Discovery's stock price gets below $35.91, and it's currently at $38.40. I'm liking my chances here. So let's do the math and figure out what return am I getting on my equity locked up in my brokerage account. So if I sold a put, I have to set aside buying power in order to buy the stock at the strike price should I be assigned? So I've locked up $3,750 in equity, and I'm earning the most I can make is the premium I was paid, $159. 159 divided by 3,750, and I'm earning 4.2% of my money in 1 month, 28 days. If you want to figure out what is the equivalent annual percent yield, multiply 159 times 12. I'm getting the equivalent of a 51% return on my money, on a yearly basis. For selling puts, I think this is an amazing opportunity. That's a pretty good deal, considering I think the fundamentals of these companies are pretty solid, and the share price is probably going to keep going up as it recovers from this whole Archegos disaster. Let's now check out the option chain for Viacom, and their IV is even higher, 58%. The higher the IV, the better premium you will get as being a seller of a covered call, seller of a put contract. The delta value for the strike price I chose, 0.453. So according to the Black-Scholes formula, I have a 45.3% chance of being assigned. Buyers are bidding $2.56. Sellers are asking $2.61. Now, when I sell these put contracts, there's three ways to profit, to capture the value of the premium faster, and that would be theta decay. Every day the value of the contract goes down, which is good for me as the seller. IV goes down. If the stock calms down and just starts trading sideways, these premium prices will also fall. And the third one is the price goes up. If the price of Viacom just drifts up, then the value of this contract will go down, and then I'm capturing more of the premium faster. So with a strike price of 41, you subtract the premium I was paid, $2.50, my break even is $38.50. So if Viacom's share price by May 21st is below 41, I'll be assigned and I have to buy 100 shares of the stock. But if it gets below, but I don't lose value until it gets below $38.50. So I'm liking my chances here. So let's do the math on what I'm earning on my money, and the strike price of 41, I'm locking up $4,100 worth of buying power or equity in my brokerage accounts, and I'm earning $250 in 1 month. 250 divided by 4,100 is 6.1%. That's a pretty good return for 1 month on your money. And if you want to multiply 250 times 12, the equivalent annual APY is 73%. Getting a 73% return on your equity by selling puts, that's phenomenal. That's just crazy good. There you have it, guys. I just wanted to point out this unique opportunity when a stock gets crushed due to a margin call. Once again, you have to be comfortable being assigned the stock. If I am told I have to buy 100 shares of Discovery at $37.50, 100 shares of Viacom at $41, I actually do feel comfortable purchasing the stock at that price, given, I think, how well the companies are going to be doing this year concerning their advertising revenue. So yeah, if I can sell some puts and not get assigned, I'm happy just to collect, let's see here, $409 in less than a month. That's a pretty good deal. Otherwise, yeah, I'll just pick up this stock and then hopefully hold it until I can get back above my cost basis and then get rid of it. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, if you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.